To welcome Trey Knippa. Trey's the owner of Kenai Capital Management. I've worked with Trey for a number of years, and at Gibraltar we're really excited to be working with him on his short Japan debt program. It's a great way to participate, we think, and position ourselves for the current Japanese economic environment. And going forward, I'd just like to remind everyone that futures, options, and FX trading is risky, and past performance is not indicative of future results. And when we're all done with Trey's presentation, we'll have an extensive Q&A period. We want to make sure everybody's questions get answered, and you can always contact us through our website here at www.gibraltarfutures.com. So Trey, why don't you take it away and let's get going.
Thank you very much, Jeff, for that introduction. First of all, listeners, you're going to hear some background noise. I'm actually on the floor of the Merc here in Chicago, and the S&P pit is still open, and it's about 40 feet from my desk. So you're going to hear some sirens. You're going to hear some yelling and screaming until about 3:15 when you hear the closing bell ring. So I apologize for that, but this happens to be my office, so that's where I'm working. When I do presentations like this, be it webinars or stand-up presentations, the first thing that I tell people is that I've got some very, very good news for you and some very, very bad news for you, and that is actually the same thing. I absolutely live and breathe to do the job that I do. Now, you should be wrinkling your nose right now saying, Trey, why in the world would that be bad news? It's bad news because I talk too fast, I talk way too loud. I oftentimes will use terminology that we use down on the floor, and I realize that I speak a little bit of a different language in some of the instruments that I'm going to talk about. So you notice the first slide that I have pulled up for my presentation is my website, theshortjapandebt.com, and my contact information. I realize that I'm going to throw out some things today. I'm going to use terminology like synthetic puts and things like that. You are going to have follow-up questions after I do this presentation today. Please do not hesitate to give me a call directly. Contact me through the website. The other reason that you should go to the website, which is here, that's the website. There's a video on there that you can watch. There's also a registration page. Mention that you were on this webinar when you go to the registration page, because if there's a pertinent news announcement about Japan, about their debt market, about their currencies, oftentimes I will send out an email update to the people who have come and registered at the site. So by all means, go to the website, register for the free newsletter, and I'll send you updates as it comes. So anyway, now on to the topic at hand. Now, a lot of people ask me why I got started. Clearly, the website is pretty obvious. The website is Short Japan Debt. I want to be short the Japanese government bond market, and I think that interest rates in Japan are going to go up, and I think that there is a significant chance that you will actually see a restructuring of the Japanese debt. In other words, a default. I think that day is coming, and I actually think that day is a lot closer than what a lot of other people think it is. The main reasons why I think this is happening. If we look back in history, back into the early 90s, the Japanese had a real estate bubble that popped. All right? So now all those financial institutions had made large amounts of real estate loans to investors, and then lo and behold, the real estate bubble popped. At one point, I think there was a 5-mile block of real estate in Tokyo that was worth more than all of the real estate in the entire state of California. Now, I would definitely classify that as a bubble. Since then, the Japanese stock market is 75% off of its highs, and the commercial real estate market in Japan is 85% off of its highs. So when the real estate bubble popped and all those losses were sitting on the books of those financial institutions, what did the government do? The government came in, and those losses and all that debt got moved from the private balance sheet into the public balance sheet. So then what did the Japanese government do? Number one, they dropped interest rates to zero. Once you get to zero, often referred to as ZIRP, zero interest rate policy, once you get interest rates down to zero, in theory, that's supposed to spur economic growth. Well, in Japan it didn't. So the next thing the Japanese did is that they come along and said, well, we need to institute a series of fiscal stimulus plans. We need to be building bridges. We need to be building infrastructure, things like that. Obviously, this story should be sounding familiar. The United States has got the playbook in Japan. By the way, I'm from Texas. If I make analogies to football, it's just how I'm made. You're just gonna have to accept that. But the United States has got the Japanese playbook, and we are following it. So the Japanese go in and they say, well, we're going to follow the Paul Krugman plan here, and we're going to borrow money. The government is going to borrow money, and it's going to go into debt, and we need to sponsor fiscal stimulus programs in order to generate some economic growth. Well, in the meantime, now the Japanese have accumulated a debt-to-GDP ratio of 230%. Now, I've got some other countries listed on here. Obviously, the United States is a big number too. But the thing that really bothers me, we can go about these percentages and that sort of thing, but what really bothers me is that the Japanese now have got a debt-to-GDP ratio of 230%. What did they get for all that borrowing? What did they get for all that spending? Do you realize that the economy in Japan is the same size today in real terms? It is the economy in Japan is the same size today as it was in 1992. Why is this not a complete failure of that economic plan of, well, the government just needs to spend more, the government needs to borrow more? I mean, this is the Krugman plan, and quite clearly it has not worked. Now, the Japanese are a little bit different from the United States in that, how do you generate GDP growth? You generate GDP growth two ways. Number one, you do it with an increase in population, and you do it with an increase in productivity. Just a quick shoot down. We're going to come back to these other slides, but I want to pull up here the population dynamic in Japan. Right now in Japan, you have more people exiting the workforce by retirement than you have entering the workforce. So when Bernie Madoff's Ponzi scheme failed, why did it fail? The Bernie Madoff scheme failed because he had more people exiting the system than entering the system. So if the population in Japan has peaked 3 years ago, then and the workforce is shrinking, and guess what? They don't allow immigration hardly of any kind, shape, or form. Then it appears to me that you have more people exiting the Japanese workforce than you have entering it, and this is a massive structural problem for the Japanese. The reason that is, as people retire, not only are they not paying taxes anymore, excuse me, long trading day today. Number one, these people are not paying taxes, and number two, we're going to go to this slide way up here. Back up to the slide. Look over on the right-hand side under the expenditures. This is a very, very, very oversimplified version of the Japanese financial statement. And if you look on the expenditure side, you're going to see Social Security. Do you realize that the longest life expectancy of anyone in the industrialized world are the Japanese? The life expectancy there is about 82 years. Also, who has the lowest birth rate of anyone in the industrialized world? It's the Japanese. The Japanese average 1.2 children per female. You need two children per female just to maintain population, much less grow population. So you've got a declining population, you've got people exiting the workforce, less people paying taxes, and more people on Social Security. Do you see that Social Security number there? You've got more retirees, as simple as that. Now, when we get into the bond discussion, this notion of people retiring is a very important part to my theory and a very important part to my hypothesis that I think the Japanese are going to be the next big debt crisis. By the way, why should this matter? I'm going to tell you why it should matter. Do you remember what the stock market did in the United States when Greece had its own debt troubles 2 summers ago? Our S&P came under tremendous pressure because of what happened in Greece. Folks, the GDP of Greece is the same size as the GDP of the state of Indiana. No disrespect to the state of Indiana, but the point is that Greece in the world scale does not matter. Japan does matter. You're talking about the 3rd largest economy in the world. If you have a debt crisis there, this is going to send shock waves throughout the financial system, and people need to be prepared for this. my dad, I was with my parents down in Texas. You'll hear kind of a Texas-y twang to my voice. I've been in Chicago now since 1996, so I've managed to lose quite a bit of it. But we were down in Galveston Island, and my dad said, Trey, if you're right and Japan does have a debt crisis, what's the world going to look like? Well, I think that if you have a debt crisis in Japan, you could see the yen somewhere in 400 or 500 to the dollar. I think that's a distinct possibility. I'll explain why here in a minute. And I think you're like I said about Greece. Greece really doesn't matter. Japan really does matter. You're talking about a major financial hub. You're talking about a major banking hub. If they run into a significant debt problem, this is going to ripple through markets. It's going to ripple through our stock market. And what my dad said is, he said, you know, Trey, this sounds like a trade that maybe I need to have on and hope that you're wrong. And in some ways he's right, because if you do have a significant default or a restructuring of Japanese government debt, the world is not going to be a very pretty place. Now, on this simplified financial statement, one of the main things that I think is the biggest catalyst and the biggest reason that this trade is so spring-loaded. Look at the top of the expenses section there. You're going to see interest expense. Do you notice? Look on the revenue side and you see tax revenue versus additional borrowing. Doesn't that just rattle you down to your boots that of their budget that they borrow nearly half of their budget every single year? That gives you a fiscal deficit of 50%. How is that sustainable? Now go to the right-hand side on the expenditure section and look at interest expense. Do you see there that interest expense is about half of their tax revenue? Right now, the yield on Japanese government 10-year bonds is 0.75%. 0.75, less than 1%. So let me get this straight. The Japanese are borrowing money for free, and their interest expense is still nearly half of their tax revenue. If interest rates in Japan go up ever so slightly, then you get to the situation where just interest expense exceeds tax revenue. They have a word for that. That word is called bankruptcy. There's the closing bell of the S&P. That's what you're hearing in the background. It'll be over in about a minute. So if I ran out and I borrowed and I ran up my credit cards, if just the interest expense on my credit cards was more than I took in income, I would have no choice whatsoever but to declare bankruptcy and restructure my debts. Do you see that how spring-loaded this is? If you see any weakness in the bond market in Japan whatsoever, I'm trying to drag this out a second, let this closing bell ring so I don't get drowned out. But if you see any upticks at all and any downticks in their bond market, I'm going to try to let this close, sorry. 12 seconds. Occupational hazard of working down here, having to listen to this every day. There we go. That's the close of the S&P futures pit. Okay, sorry about that. So if you get the smallest break at all in the bond market and that interest expense exceeds tax revenue, it's over. That's when you see a major restructuring. Well, I'm not talking about a move in rates to 30 or 40% like you saw in Greece. I'm talking about a move in the 10-year up to 2.5%, 3%. If you get up to 2.5%, 3%, where you get interest expense as some multiple of tax revenue, then that's it. That is checkmate for the Japanese. And that's what I'm trying to position myself for, because once it starts to move, then I think this trade moves quickly. If you look back at what happened in Italy 2 summers ago, you saw the 10-year bond in Italy, you saw interest rates there go up 250 basis points in 5 weeks' time. If you rallied the Japanese 10-year 250 basis points, that would put you to 3.25%, and that you are in the checkmate moment right there. This could literally unfold in 5 weeks. And at that point, the bond market could just completely spin out of control. And I think that that's the way that this goes once the market starts to move. We're going to talk about a catalyst of what would make that happen. But I wanted to really burn this in about how important it is to see that interest expense. So if the farther bonds go down, the more pressure it puts on the Japanese government, and it pushes them closer and closer to that really painful restructuring. Now, what are some things here that could make this happen? Well, I'll tell you the biggest thing that I think is going to make it happen. Notice this top right hand graph up here. One of the reasons that the Japanese have been able to finance, do you realize that 92% of all the Japanese government bonds are actually owned by the Japanese themselves? They're owned by the corporations, they're owned by the institutions, they're owned by the banks, and they're owned by the individuals. Why would somebody lend the Japanese government money at 0.75%? Well, if you'll think back to the beginning of my presentation, I said that the stock market's 75% off its highs, et cetera, et cetera. You have also seen a very strong yen in that time, which is here. Note in this chart on the right-hand side, this is the long-term picture of the yen. The yen has been strengthening to the dollar. You'll notice it from back in the mid-'80s, it's gotten very strong to the dollar. So, number one, they held a strong currency. Number two, you've seen deflation in Japan, which means you've seen prices actually work their way lower. So I'm willing to hold on to a bond that yields 0.75 because if I've got deflation of 2%, well, then that gives me a net yield of 2.75%. So to the Japanese, that's acceptable. Also, since their stock market is 75% off of its highs, to the Japanese, hey, if I give you my money and you give it back to me, hey, that's a great investment. So you've seen all the Japanese savings and all their current account surplus has been used to finance this government debt. Now let's go back to this other slide here where we look at their fiscal deficit. Sorry, I went the wrong way. Notice the chart in the upper right-hand corner. Now you are moving Japan into a fiscal deficit, meaning that they import more than they export. One of the main reasons that this is happening is energy prices. Note back when the tsunami happened March 3 years ago, what closed down? All the nuclear plants in Japan closed. So now the Japanese do not have a major source of energy, so they have to import. They do not have a major source of minerals, raw materials, things like that. So this is a big part of the reason that they have this now a current account deficit. So one of the big ways that they've been financing their debt is with the current account surplus, and then now that is gone. So that is part of the pressure. But I think the biggest pressure, Japanese interest rates have been low for a very long time, and I'm not here to argue that point. In fact, the bond market has been rallying over the last couple of years since I started watching this trade. However, what is the catalyst, and what is going to push this forward, and what is going to change this model? I will tell you, that is two words: Shinzo Abe, the new Prime Minister of Japan. This arrow here points to the Japanese yen futures when he got elected. So the new Prime Minister of Japan has now taken office, and he is promising a 2% inflation target. He has also said that he will support printing unlimited amounts of yen to generate this inflation. All right, there's a variety of problems with that. Number one, that's odd. I didn't realize that the Prime Minister dictated monetary policy and how much yen is going to get printed. Oh, wrong indeed. The Bank of Japan gave him some pushback when he first said that. So you know what he did? He said, fine, now I've got a 2/3 majority in the House. I'll just change the law. So now the notion of an independent central bank in Japan is completely been obliterated by the election of their new prime minister. He's saying he will print an unlimited amount of yen to generate this 2% inflation. In my opinion, he has lit the fuse on the Japanese government debt bomb. And the reason that I say that is twofold. Number one, if I owned a Japanese government bond and he is promising inflation of 2%, why would I want to hold on to a bond that yields 0.75 if you've got 2% inflation? If he is going to print unlimited quantities of yen, I have lent as a bondholder, I have lent the government money, and they have given me a piece of paper. They are going to give me that money back at the end of the term of that bond. So if I'm looking at this and I see the yen being devalued, why would I wait to get my money back to be paid back with a devalued currency? he is putting pressure on his bond market. And guess what? It's not just me saying this. If you go, there's a gentleman, a Japanese gentleman, and he happens to manage the largest pension fund in the entire world. This is the pension fund of the Japanese government workers. This pension fund has an asset allocation of 67% Japanese government bonds. They interviewed the manager of that pension fund. You know what he said? He said, well, if Shinzo Abe reaches his inflation target of 2%, then he is going to have no choice as a fiduciary. He's going to have no choice but to lower his asset allocation out of bonds and into other instruments. So the largest pension fund in the world, they are selling Japanese government bonds because he worries about that risk of inflation. So this new prime minister, he has set an inflation target, and I think he risks setting off his debt bomb, because what I think happens here is, if the first thing that will more than likely happen in this scenario is I see a lot of yen weakness to come. If we go back to this chart that we saw here, the yen, in my opinion, has only made a small move. And I've got a lot of customers say, Trey, if the yen bounces, call me. We'll short it then because it's just moved too far. Guess what? The yen, I think, has barely begun to move. I mean, look, just back in 2000, the yen was at 100 to 120. And the yen just now has moved from 77 up to, what, 93 right now? So I think the yen still has a long ways to go. At what point? Right now, they are doing what I consider to be an orderly devaluation of the yen. When does this become a disorderly devaluation of the yen? I think it becomes a disorderly devaluation when bond interest rates start going up. Because if bond interest rates start working their way higher, sorry, those are phones here on the floor. If bond interest rates start working up, the way I see this panning out is the Bank of Japan is going to print an inordinate amount of money trying to support that bond market to hold it together. So how could you see the yen go to 2, 3, or even 400 to the dollar? I think it happens because you run into a debt crisis. When their bond market starts working its way down, the Bank of Japan tries to step in and support it all they can. That's when you'll see that move in the yen that is a non-structured move, that is a disorderly break in the yen. And like I said, I think that day is coming. Now, what am I doing? How am I positioning myself in this trade? First of all, there's a guy's name that you need to look up after you've listened to my webinar. You need to look up the name Kyle Bass. Go on YouTube, and there's a whole bunch of speeches and interviews on various financial networks with Kyle Bass. Kyle Bass lays out a very good case. He's an institutional money manager, and he lays out a very good case for why he thinks this is going to happen. Well, guess what? I was on the floor of the Merc one day, and down on the floor here, we've got these big TVs like Diamond Visions at a baseball game. I looked up, and I saw an interview with Kyle Bass. Well, I started my career with Prudential Securities in Dallas, Texas. He started his career with Prudential Securities in the Fort Worth office. So I saw him. I had met him. I mean, we're talking the early 90s here, back in like 1993. So when I saw him on the Diamond Vision here in the Merc, I just said to myself, oh, I remember him. So I pulled up an interview on CNBC, and I listened to what he had to say, and this was the genesis of me getting interested in this trade. So I watched the interview, and I started doing homework on my own. I tore down the numbers of the Japanese. I went to the Japanese Ministry of Finance. I pulled out their budget projections, things like that, and I realized just how spring-loaded this situation was. So I decided that I needed to take a position short this bond market. So the first thing that I did was I called his fund. Well, his fund had a very large minimum. I mean a minimum up in the 8 figures range. So I thought, okay, well, that's not appropriate for me. So I have to try to figure out a way to get some of this risk for myself. So I called my friends at Goldman Sachs in New York. I said, hey, guys, I need to buy some credit default swaps on Japanese government bonds. They said, Trey, no problem. Deposit $10 million into your Goldman account. You can have all the credit default swaps you want. Ugh. All right, strike 2. The next step was, I said, well, I've got to try to figure out a way. So they sent me to their structured products desk at Goldman Sachs. You see where the story's going. I go to the structured products desk. They say deposit $10 million. I roll my eyes and say, okay, looks like I'm on my own here. So for an for an individual investor, how do I want to try to execute this? So the first thing that I found out in my research is that they trade a futures contract on this at the Tokyo Stock Exchange. So I got my computer systems hooked up to the Tokyo Stock Exchange. I got the 10-year Japanese government bond futures. Great, a futures contract, that's perfect. That's what I do for a living. So I get the futures contract pulled up, and I short their futures, and I think I managed to lose about $20,000 in 3 or 4 days. The reason that I bring that up is that the contract that's traded in Tokyo is enormous. That contract has an underlying value of about $1.6 million worth of Japanese government bonds. Ugh. So I get my ears torn off in the matter of about 3 days, and I realized, I said, okay, Trey, you're not using your head here. You're not thinking this through. Then I found out that they do trade options on those futures. Great. So I buy a bunch of options, they expire worthless. I buy a whole bunch more options the next month, they expire worthless. That's when I took a deep breath and I said, okay, Trey, we need to rethink this strategy a little bit here. The risk of this trade, as I see it, is time. I haven't the slightest idea when or what is going to be the catalyst for you getting this fracture in the confidence. Remember what I said early in the webinar, that bond markets, banking systems, and currencies, they all require one thing, and that one thing is confidence. When the confidence in Japan gets fractured, you are going to see a move in this bond market and in the currency. When will you see that crisis of confidence? I do not know. So it is my job to try to extend my exposure for as long as I possibly can until you get something happening. So I'm registered as a CTA, and how I do things in the CTA is I've got my strategy divided into 2 phases. Phase 1, I'm going to buy out of the money options and wait. As you buy out of the money options, you are going to see significant amounts of option decay. Right now, I'm trying to budget for my fund. My fund, I manage money in increments of $30,000. So let's talk about this theoretical $30,000 account. Well, right now, my $30,000 account, I'm purchasing and I'm getting option decay of about $500 a month. Now, what I'm doing is I'm buying these out of the money options because I'm waiting for the first move to happen. I don't want to be short futures. I want to be short futures after we break. So I want to try to catch the first move in options, and I'm willing to accept a little bit of option decay every month. So if I've got, say, around $500 of option decay every month, and I've got this $30,000 under management in this theoretical account, well, that gives me a window of roughly 5 years before that money runs out. If Japan's bond market never works lower, then yes, I'm going to keep getting this option decay every single month. That's just simple mathematics. But by positioning this way with some out-of-the-money options, this tries to extend the life of the money that I have, and it just lets me participate while I wait for something to happen, while I wait for that fracture of confidence. Phase 2 of the fund. Phase 2 is after you get a first move down. Let's say you moved rates to, say, 2%. Now, this should sound funny to you. If you move rates from 0.75 to 2%, you would be at a virtual crisis point in Japan. And my options that I own get triggered if you get a move of 50 basis points. So those options would go in the money and show profit if you manage to get rates to move just 50 basis points is when my options get in the money. So a move all the way to 2% would be a really big move and a really good move for those options that I own. So phase 2. After you get a move in rates and you get that more than 50 basis point move and we're able to put some profit away, I want to convert those options into synthetic puts. A synthetic put, and right now I realize people are probably rolling their eyes going, oh my goodness, what's a synthetic put? A synthetic put is short futures and long calls against it. The reason I want to be short futures is simple. 2 primary reasons. Number 1, you know what I'm really scared of? I'm really scared that if their bond market works lower, isn't it likely that the Japanese would do something very Japanese, like pass a law outlawing people shorting their bond market? I think that that's entirely likely. So if I own some options, I don't want those options taken away from me. So guess what? They trade a futures contract that trades in Singapore. But right now, so I don't think Singapore is not going to delist that contract just because Tokyo outlawed shorting their bond market. So I think the Japanese may do that. So this gives me an avenue that I can still short their bond market on the futures market in Singapore. But the other reason that I want to be in the futures is that if you did move rates to 2 or 3%, the Bank of Japan is going to be printing money like crazy. If I just own straight options, those options are going to be making money, but I'm going to be making money in yen. No, thank you, because the Bank of Japan is going to be doing is they are going. That's when you might see this non-orderly devaluation of the yen as they're printing unlimited quantities of yen to defend their bond market. So I don't want to be getting my profits in yen, and if we're short futures, the futures profits get marked to the market every 24 hours, so I will be able to sweep those profits out of yen because we are not going to want to be getting paid in yen if you're running into a full-on debt crisis in Japan. So that's why that's why I've written the strategy the way that I have. Buy options, wait for the first move. Then, once we do get some kind of a move, then we convert those options into a synthetic put position. That way we can be short futures. So clearly there's suitability requirements here. This is not appropriate. Clearly I've stated that if you do not get any movement in the bond market in 5 years, then I'm seeing option decay every single month. But guess what? In a CTA, there's no lockout. If you lose faith in the strategy after a year, fine. I'm having to renew these options every single month. So every single month we've got a limited amount of exposure to the market and to this trade. So that's how this whole trade was designed. We want to have a defined limited amount of risk at the beginning. Then once we have some equity after we catch that first move, that's when we roll into the futures position. So, like I said at the beginning of this webinar, I talk too fast, folks. I realize this. Go to the website. If you want to set a time for a call, send me your contact information. Send me an email. I'm happy to go over this as many times as I need to in a way that I talk a little bit slower and a little bit clearer. You know, maybe you'd like to write it down so I can show you just how these instruments look. But right now, I want to stop, take a breath, and go into the questions here, and I'll pick out a few of the best questions and try to get things taken care of. Let's see here. Let's see here. I'm trying to figure out how to look at these questions. Let's see. Was everybody able to hear me? Oh no. Tell me I didn't do that and nobody could hear me.
No, Trey, it's Jeff. I think the sound was good. We did have one person with an issue, but I think we're okay.
Oh, thank goodness.
And we do have some questions there.
Jeff, I don't know how my screen is structured here, but I'm not able to see these questions.
First question, do you see him there? There's one from Steffa. Is it true Japan owns 60% of world equities?
I don't know. I'd have to look that up. That seems that seems a little high that Japan would own 60% of all the world equity markets. That seems a little bit high to me, but I can certainly look it up. That seems a bit high. The next question after that is the basic idea to short the yen. I am in favor of shorting the yen, and I do think that investors, I do like that position. I've been doing it myself, and I like some of the options that are out there. I've been trading options on futures, things like that. So yes, I do like the yen short because truthfully, I think the yen moves first. Shinzo Abe, the new prime minister, he's been pretty clear about wanting to devalue the yen. He is getting a little bit of heat from the international community, which I actually kind of find funny. Angela Merkel, she said, that's not fair that he's getting to devalue his yen. Oh, really? It's not fair because they're trying to do it too. You are in a currency war right now. Everybody is trying to devalue their own currency, and guess what? We're doing it in the United States. You know what I find odd, though? Do you know who's conspicuously absent from this criticism of Japan? I have not heard United States policymakers be terribly tough on Japan here as they've devalued their currency. And I have a theory for why that is. We need a strong ally in the region, and I think that as China grows its military presence, Japan is kind of our first line of defense. So I think that the United States, in some ways, has kind of turned a blind eye to what the Japanese are doing to their currency, just because I think we need them as an ally in that region. So the yen, I think the yen has a long ways to go, and I really like. I really like the yen part too, because I think the yen really moves first. Let's see. I'm scrolling through these questions now. Let's see here. The name to look up is Kyle Bass. Kyle Bass, B-A-S-S. Go to YouTube, type in his name. There's some really good interviews with him. I mean, quite frankly, that's why I started doing the research on my own, is because of interviews with him. So I strongly advise going on YouTube, searching for his name, and listen to his case, because, number one, he is an exceedingly smart guy. Number two, that he really does his homework. And some of his conclusions, he's a really good speaker, and it's certainly worth your time. Somebody's asking for for a copy of the presentation. I'll leave that to the guys at Gibraltar Futures. I'm sure they're taping this, and they'll figure out a way to get a copy to that. Any other questions while I'm on here? Like I said before, go to the website, register at Short Japan Debt. I do put
Trey,
out
it's Jeff. How are you?
Go ahead.
Trey.
Yep.
It's Jeff jumping in. Hey, listen, why don't you go over a little bit about some of the what you see as the profit opportunity in your program in terms of returns and that structure?
Well, when you start making profit forecasts and profit projections, that's when you really have to be careful from a disclosure point of view, because my intent is to not mislead anybody here. So let's just take things and let's talk of it outside the scope of my fund. Let's just talk about where the futures index is right now. And if the futures index moved from here to here, what is possible? What is possible in terms of profit? Well, because that futures contract is so big, right now, let's just say you shorted 5 contracts of the Japanese government bond futures. And I'm not advising that you do this, because that's a really, really big position. But let's just say you shorted 5 contracts, and the market moved from here until you got and the market moved and you saw interest rates up around 6.5%. That 5 lot would make somewhere in the neighborhood of $3.5 million with a move to 6.5%. That gives you some idea of just how big this contract is. Now, in my fund, I am not short 5 contracts. However, for every 30,000 under management, I own 5 puts. So is it possible? Could you have the bond market move? And these puts that I'm buying have a relatively short life. So is it possible that you could have a move all the way to 6.5% in 1 month? No, I find that highly unlikely. That's why I've got phase 1 and phase 2 here. But I think that the upside is significant, and I also think the speed at which this happens. What's going to cause that crisis of confidence? What is going to cause that fracture in confidence? I don't know. I really thought the tsunami would have been a major contributor to that, and it wasn't. You've actually seen bond yields go down since then. But what is going to be that fracture of confidence? I don't know, but I do think that once it happens and once they lose control and once you move into that disorderly move in the bond market and in the currency, it is not inconceivable that you could see rates go 3, 4, 5, 15, 20, 25. It could really happen very, very quickly.
Okay, thanks, Trey. Now, Trey, did we get an answer to the last question about ETFs and a hedge in a full-blown debt crisis, which actually we should kind of make clear that is basically what your program is indeed all about.
Give me it in the form of a question there.
What
is the question about the ETF? There is an ETF out there. It's called JGBD, and it all just boils down to what's suitable for the individual investor here. Is my fund suitable for everyone? Of course it isn't. Is the ETF more suitable for somebody? It's actually an ETN, I think. Is that more suitable for some investors? Of course it is. It just depends on the person. However, mine has an awful lot more leverage to it. That's the primary difference. But with that leverage comes option decay. We are going to be losing money steadily in option decay every single month. But that is a conversation that I'd have with every potential individual investor, and I'm happy to kind of walk you through just what I'm doing and how I'm positioning myself. One ancillary benefit, and I'm not saying this to be funny, I'm saying this because even though it is a little bit entertaining, remember the options that I'm buying are denominated in yen right now, and so some of the people who've gotten in my program and who've gotten into the CTA, I mean, obviously, all there's been is losses because you haven't had a debt crisis in Japan. But the nice thing is that we are accumulating losses in these options in yen, so I leave those losses in yen, and I borrow the yen. So I leave. So the investment comes in dollars. I do not convert those dollars into yen to pay off those losses. I leave the losses in yen. So here, what's been great since September is you've seen a 20% devaluation of the yen versus the dollar. Well, guess what? As I keep those losses in yen, I'm actually getting some of my money back because of the currency conversion. And guess what? I have no intention of paying off those losses in yen. I will continue to borrow it because guess what? Interest rates in Japan are low. I think my interest expense last month was 64 cents on all those losses of yen. And guess what? As the yen gets devalued, I'm getting to pay back those losses with a devalued currency. So we'll go here to my guy Shinzo Abe, and I cheer his efforts. By all means, devalue the yen. Take the yen to 200 to 300 to the dollar because number one, it's going to set off my trade, and in my opinion, it's going to make it work. But all the losses that I've taken thus far, he's making it cheaper for me to pay those losses back. So Shinzo Abe, my hat's off to you, sir. Please continue to devalue the yen.
Well, that's great, Trey. Thanks a lot. And I just want to remind everybody that everybody that participated in this webinar will indeed have the ability to access it recorded. There were a couple questions about that. You will get links. It was recorded. And just to remind everybody that futures, options, and FX trading is risky, and past performance is not indicative of future results. And we really enjoy working with Trey. Contact us here at Gibraltar Futures, Jeff Gannis or Travis Vincent, we're the owners, or Trey directly at his site, as he mentioned. And we look forward to hearing from everybody. This is a hot topic, and we're very excited about it. Thanks a lot, Trey.
You bet. Thanks for having me, Jeff.
Okay, bye-bye.